I've created an incredibly diversified retirement growth portfolio using only these 4 ETFs. And with this super simple investment strategy, I have exposure to 7,500 stocks from around the world, as well as 2 cryptocurrencies. In today's video, I'm going to break down what each of these ETFs are, what percentage of the portfolio I'm allocating to each one, and also I'm going to show you the results of this strategy over the past year and compare it to some benchmarks. The first ETF in this portfolio is ticker symbol XUU, which is the Total US Market Index ETF from BlackRock. This is the Canadian version, but the same thing is in the US and it would be just ITOT. Now this ETF is the cornerstone of my retirement growth portfolio, and in fact it accounts for 50% of the total portfolio. It tracks the total US stock market, including large, medium, and small size companies. And the reason why I like this ETF so much is because it's incredibly diversified. It has 3,356 underlying holdings, which means it actually tracks 3,356 companies based in the US. So by owning one share of this ETF, you are owning tiny fractional amounts of over 3,000 different companies. And really the benefit of this, as opposed to just investing in, for example, the S&P 500, where you have exposure to the largest companies in the US, is that with this ETF, you get broader exposure to the entire market and have much better diversification. Now, in terms of the dividend yield, it's not super high. It's around 2% per year, but that's not really the point here because this is an all equity growth focused ETF. But really one of the main reasons why I love this ETF is that the management fees are super low. It's less than 0.1% per year to hold this ETF. And so with an investment in XUU, or the US listed counterpart, which is ITOT, you get access to the entire US market without having to pay high management fees that you pay, for example, if you invest through a financial advisor or through a mutual fund even, where sometimes fees can be above 1% per year. Now, the reason why my target allocation for this ETF in the portfolio is 50% is simply because the US is the largest market in the world. It is traditionally the most stable and has the highest growth over time. And so realistically, targeting a large percentage of a retirement portfolio towards the US is a smart move because not only is it safe, but also it is likely to perform well over time, which is key. The second ETF in this portfolio and the second largest position is ticker symbol VCN, which is the Vanguard All Canada Total Stock Market Index. Now, I've included this ETF in the portfolio for a couple of reasons. First of all, Canada is a well-established global market. And secondly, the types of companies that are listed on Canadian stock exchanges are not exactly the same as those that are listed on US stock exchanges. For example, in Canada, there's more of a skew towards energy stocks and resource stocks. There are some tech stocks and financial stocks as well, but you're getting generally a different group of companies than you do get if you invest only in the US market. And so for that reason, there's additional diversification as well. Now this ETF trades for around $40 a share. The management fee is super low. It's even lower than the US total market at 0.05% per year, which is great, and it has a dividend yield of around 3%. Now, in terms of the number of stocks, there's far fewer in this ETF. There's only 182, as opposed to the over 3,000 from the US market. And my target allocation for this ETF in the portfolio currently is 25%, although I'm thinking about adjusting levels a little bit here and there as I go along. The third ETF in this portfolio is ticker symbol VIU, which tracks developed markets around the world. So not developing markets in emerging economies, but already established developed markets, excluding North America. No Canada, no US. Now, if you live in the US, there is a version of this traded on the US stock markets as well, which is ticker symbol VEU, which is a very similar ETF. Now, for this ETF, my target allocation is 20% of the portfolio, and that gives me exposure to developed countries all around the world. Now, just to give you an example of the types of countries that are tracked in this ETF, you've got, for starters, Japan, the UK, France, Switzerland, Australia, Germany, South Korea, and so on and so forth. And one of the main reasons why I like this ETF as opposed to some other ones that include emerging markets is that most of those other ETFs include China. And I have made a conscious decision to avoid investing in Chinese companies. For starters, because there are some principled reasons on my part for not doing so, but mainly because of the practical geopolitical risks that are involved in Chinese companies. For example, over the past few years even, we've seen the Chinese government step in and interfere in their markets We can look at, for example, Alibaba stock as just one prime example, but this is at risk of happening at any time. And so personally, I don't consider an investment in a Chinese mainland company to be safe. Anyways, this ETF is again great for diversification because it gives access to 3,865 companies all around the world for the price of around $30 per share. Now the management fee for this one is a little bit more expensive at 0.23% per year. And as you can guess, that's because it's tracking different markets in different countries all around the world as opposed to just one market in one country. So it takes a little bit more effort to do that. The dividend yield for this hovers at around 2.5%. But again, that's not the point here. We're really investing in stocks for growth purposes. So with these 3 ETFs alone, I have exposure to around 7,500 companies all around the world, which is incredibly diversified. And that's what I love about this. It's such a simple strategy, but it really gives you access to an entire world of opportunities in the investment space. Now there is one final ETF that I've included here in the portfolio with an allocation of 5% only, but I think it has potentially in the medium to long-term future, really huge upside. And so I think I would be remiss if I didn't include it in the portfolio. And that is ticker symbol ETC, or the Evolve Cryptocurrencies ETF. Now this one is only available in Canada because in the US they have not yet approved spot Bitcoin or Ethereum ETFs, but in Canada they have. And if you can invest in Canadian markets, then you can invest in ETFs like this one. Now the reason why I really like ETC is because it's a hybrid ETF. It actually takes Bitcoin and Ethereum and it puts them together into one package that you can purchase currently for around $5 per share, and you get access to the 2 underlying assets. The allocations on this one are weighted at around 70% Bitcoin and 30% Ethereum, but the beautiful thing about this ETF is that you don't have to worry about holding the cryptocurrency and having custody of it. Now let's talk about performance of this total portfolio over the past year, and I'll compare it to a couple of different benchmarks so that you can see how well it's done. Now, as you can see, over the past 12 months, this portfolio has returned -2%. Now, that may seem bad, but actually, if you compare it to some different benchmarks, it's actually done surprisingly well. In fact, much better than some of the other investments that I could have made with this same money. If I look just at the US stock market, for example, ITOT, which tracks the total US stock market over the same 12-month period, that ETF is down 8.66%. If I look at the S&P 500, that's also down 8.6%. If I look at the Canadian market alone, that's down 7.3%. Actually, over the past 12 months, the global developed markets are up nearly 5%. And the fact that I've allocated 20% of my total portfolio towards this ETF is really what has made the difference. And so really the key takeaway here is that the global geographic diversification that I have here, combined with the cryptocurrency investments, has made for a portfolio that is more resilient to the types of economic shocks that we've seen. And if I put all of my eggs, for example, in the US total market, then I would be down significantly more than if I had a nice diversified portfolio across different countries. Now, of course, if the US stock market goes on a major run and goes up, let's say 20-25%, I'm gonna miss some of that upside because I've only got half of my portfolio in that. But on the flip side, when things don't go so well and they are doing better in other global markets around the world, then the opposite case is true. And there's 2 final important points that I want to make. First of all, this type of investment strategy is perfect for people that want to invest on autopilot but don't want to pay high fees associated with hiring a professional money manager or even just putting money in a mutual fund where sometimes they charge 1 or 2% of your total investment per year just to do the same sort of thing that you could easily do by holding an ETF that charges you less than 0.1% per year. Secondly, this is a growth portfolio because I'm only invested in stocks. There's no bonds, there's no treasuries, there's no real estate. I'm not focused on generating income from this. I'm focused on long-term growth. And there's 2 reasons for that. First of all, I'm young and I won't be drawing on this portfolio for a long time. So at this point, what I'm more concerned with is growth. Secondly, I have a pretty high risk tolerance. So the fact that this portfolio could go up 20% or down 20% in any given year is not really a concern to me. So if you consider yourself to be in a similar situation with a similar type of risk profile, then maybe this type of investment strategy is worth considering. Anyways, thanks so much for watching. Hopefully you found this interesting or useful, and I'll see you later.